Hello, everybody, and welcome to today's Ask Me Anything. I'm joined with Eric Joern from Kaizen CPA. I said that right, correct? Kaizen.
You guys got it down.
Nailed
I
it.
appreciate that. Love it. Love it.
Today, we're going to be talking about why you're not as profitable as you think. This is an AMA, so as you guys are asking questions in the comments, me and Eric are going to be paying attention to that and making sure that we get those questions answered. Okay. A few things I want to just touch base on, and we'll revisit this again, but we have a few things that we've got coming up that we're doing in partnership with Kaizen, which is we have a financial intensive, which is going to be going over all of your finances, getting everything set up correctly here at Institute headquarters in April on the 23rd through the 24th. I think it's a 2-day. You guys can find that on our website at wearetheinstitute.com/events or upcoming events. And check that out. It's going to be fantastic. Eric, do you want to speak a little bit to that?
Yeah, I'd love to. We're excited. We have our whole entire partner group will be there. So you are getting the whole roster of heavy hitters, and it is going to cover finance from A to Z, meaning how to just interpret financials, your basic P&L and balance sheet, and what information to glean from that, all the way to I've exited my business, and how do I manage that new wealth that I created through the process. And obviously the steps on how to get from A to Z to that wealth creation stage.
I mean, we've had a lot of people, especially through our roundtables and through the Institute work, that have asked for, something like this. And we spent a lot of time going through all the items that need to be included in that, us as well as, I guess I'm Cecil today.
I love it.
But to really just define exactly what you guys need in an intensive. So if you're really scrambling with your finances, this is the intensive you should attend. And the last thing, and maybe I'll say that for later. Let's just jump into some content, okay? So Eric, I'm going to ask you, why, in your experience with the shops that you worked with, why do you feel that they're not as profitable as they think they are?
Wow. Do we not only work with around 200 shops ourselves as current clients? We probably talk to another 200 shops every year that are not clients. So when we're going through the financials, right, that actually one of the biggest questions we get is, I made money on paper, but I have no cash, right? And profit can be an interesting thing to think about, right? You can just say, hey, this is what is on my P&L and I'm good and happy with it. But what we don't know is we're hyper leveraged, meaning we used a bunch of loans to buy everything that we needed. Or hey, we're early on year 1, 2, or 3. We had to go out to the bank, get loans to buy all the equipment, to maybe we bought the shop, and now we're paying that debt service. Well, that's not accounted for on the bottom line on your P&L. No, that comes out of your profit. So that might be one of the supernatural reasons why you might not feel like, hey, I'm as profitable as the P&L my accountant gave me, or even worse, the tax return said.
I mean, there's a lot of things you can look into. I've had a client in the past where, they were doing about 27% net profit. And so we went through the numbers. We looked at their GP, we looked at their parts, we looked at their labor, we looked at their expense controls and everything, and they were a 27% net operating profit. But like you just said, they were over leveraged. They took a lot of loans. They overextended, and so their debt repayments every month was like $13,000. So it was eating all of their profits up, let alone being able to set anything aside for taxes or for being able to have a cushion, right? I mean, how many shops out there have you worked with that don't have that 3 to 6 months of operating capital?
Yeah. Build a reserve, right? Pay down debt, eradicate debt, build a reserve. Oh, and you got to pay taxes too, right? So maybe you hit $300,000 of profit on paper, and you could be that profitable performance-wise. But now we're paying a third to Uncle Sam, a third goes to debt service, and a third is sitting in our savings account because we had no emergency savings.
That's right. And think about that. So if you're showing net profitability on paper and you don't have any money, what's going to happen come tax season?
Yep. You're gonna get squeezed. I call it the tax squeeze.
It hurts. It punches you in the face.
It's something that we dealt with a lot. We've worked with businesses outside of the automotive repair industry. Our construction contractor contracting friends, right? You guys see them in your shops, right? They get new trucks pretty frequently because they don't want to pay tax, right? So they're buying trucks every year, but they buy them on loan. And eventually we run out of deductions because we're accelerating. We're super aggressive because we don't want to pay tax. And now we got to pay loan payments, but I run out of deductions. Next thing you know, I have no cash because I'm using it to pay my trucks off, but I don't have the tax deduction because I used it or maybe even wasted it in prior years. Now all of a sudden, I don't know where I'm going to get the cash to pay my taxes. And we see them on installment plans for taxes all the time.
So, there might be somebody out there right now who's like, well, I'm not profitable, so I'm not even showing profit on paper. How do I, in fact, I'd love to just talk to you about this, about cash flow strategies. How do I know if I'm in a healthy position or not?
Yeah, we, couple things, right? So we can put on our banker's lens, and a banker is going to look for 1.5 to 2 times what's called debt service coverage ratio, meaning I'm making enough profit and cash flow from my operations to cover my debt at least 1.5, my debt payments at least 1.5 to 2 times throughout the year. So meaning if say,
so what's Eric, what would be the formula for that? How would I know what my ratio is and whether or not I'm 1.5 to 2 over?
Yep. So what is your principal portion of your loan payments? So meaning I make a $2,000 per month loan payment. Of that, $1,500 pays down my principal. $500 is expensed on my P&L as interest expense. So we have then our net profit at the end of the year. So say that is $100,000. And well, actually that already does. No, it maths out. Never mind. It doesn't. So we have 18,000 that we have in debt service, and we have 100,000 in profit. Right? We're now covering that debt service 5 times. It's 5 and change, but let's just say 5 times we're covering that. So that means with the profit, we can afford to pay our debt payments 5 times. Good, healthy position to be in.
So then you're in a healthy position there. But if you're below 2, how does the bank view that?
Yeah. Two, they have to sit in front of a loan committee and make a hard decision, right? And that, you might get some emotional decision making to make a debt decision, right? They might say, we got to look now at history. What does pro forma look like? What do we look at going forward? And we don't want to get into a point where we have the bankers making an emotional decision, right? At the end of the day, they got to get paid and they got to safely get paid, right? They're going to evaluate a risk-based decision. So when we're at 1.5 to 2, I believe under 1.5 is almost at least for most lending situations that we go to. Now you can go SBA. There's a lot of other routes you can jump through, but most banks aren't happy with the 1.5. 1.5 is bare bones bottom line. So we really want to see that. And that's
and especially
leverage.
Depending on the bank that you work with, you might not have a great conversation with them because they're not going to be kind of like a smaller bank that is looking at loans like that. They might be large and they wouldn't care. It wouldn't be worth it to them.
Absolutely. And then they're going to look at something like a current ratio, right? How much do I have in current assets? So now we're moving to a balance sheet, right? Which is weird. Most of us don't even look at a balance sheet ever, right? How many shop owners actually know what's on their balance sheet?
So just to recap, we have debt service coverage ratio.
Yeah.
Right? Okay. And then now you're talking about your current ratio. What's the current ratio?
Yeah, current ratio is simple equation. Current assets divided by current liabilities. So what does that mean? So say I have a lot of terms with my parts vendors, right? And at the end of the month, a lot of us as shop owners have been in this position. We've kept our finger off the pulse, and next thing you know, we get that parts statement and it's 15,000. We got 10 grand in the bank, and our heart clenches a little bit. Well, we have an under 1 debt service ratio, right? We have less cash than we have debt owed to our vendors. And we're talking short-term debt, meaning these are things that we have to pay in less than a year. So that's what
not even that, but those short-term is going to have a lot higher interest rate on that.
Exactly.
So even you could be making payments and feeling like you're making a dent, but it's not touching the principal.
For credit cards, right?
It's not touching the principal.
Exactly. Yeah. So we want to see that at least over 1, right? And it really depends on what your how much volume to go through, right? If we're constantly churning, if you're just barely over one, well, that gets a little scary, right? You lose one, something happens, the shop has to shut down for a period of time.
You're not going to have that cushion to be able to keep operations up
Yeah.
because you don't have it.
Yeah.
I advise, taking some kind of percentage and doing an allocation every single month or every period where you're going to be doing your regular rhythm, either the 12th or 25th, whatever your rhythm is, and just setting aside that money just cause. Put it in a bank account that you have to physically go to pull money out, just so that you know that if something happens, it's there. It's not touched.
New shop owners using that principle.
Go ahead. Sorry.
New shop, we're new at this, I guess.
Yeah.
New shop owners, one of the biggest things that we see, sales tax debt, because they don't do exactly what you talked about, right? Every 10th, 25th, whatever it may be, we're moving that money over. That is, I'll call that precious cargo, is sales tax money that you collect, because it's never really yours. You're just taking it, handing it off back to the state. It's not an income, it's not expense.
What would you recommend in terms of how much should I be putting away for that?
For sales tax, well, the great news is you can run a report on your shop management system that tells you exactly how much sales tax you collected. That's the simplest way to do it, right? So we're on Friday or maybe Monday every week. We go and we looked and see in our shop management system, we collected, $2,000 in sales tax. And we're going to transfer that money right over into an account that we pay our sales tax out of. And that way we don't spend it. And we're getting into profit first concepts. I actually taught a class on profit first, I think last week or the week before.
It's something I'm personally really passionate about. I've been doing profit first myself personally for, a very long time. And it's something that's I also did it in juxtaposition with Ramith, the automated, I'll teach you to be rich.
Okay. Yep.
Because behaviorally, I'm impulsive. I have ADHD. I have a hard time managing my finances. So I try to create the systems that are automatic that I don't have to touch, because as soon as I touch it, I'm going to break it.
Yeah. Oh, 100%.
And I'm going to ruin something. But for me, I also make sure that there's at least an additional cushion on top of that. Not just, say we took in 2,000, but maybe I might have a 5 to 10% cushion on top of that to say, okay, instead of 2,000, we're going to do $2,200 and move that over.
Absolutely.
Right. So that you have just a little bit more just in case, because something always happens. Something always comes up.
And the great news, if the cash is not in your bank account, you're probably not going to spend it.
Exactly. I don't see it. It doesn't exist.
Yeah.
Right.
100%. All right. So we talked about cash flow, but now let's talk about, hey, I think I'm like most shop owners, we're probably mostly making our profitability decisions based on our shop management system only. And I think
half the conversation there.
Exactly. I think most of, why shop owners think they're profitable and then they're really not come from, hey, we have not captured accurate data inside of our shop management system.
That's the other thing is I've brought on a few new clients over the past, 1 or 2 months, and we go in there and we're looking at their labor GP. The shop management system says that they're at 70% or around there. And I go, all right, I automatically don't trust that. So let's jump in. And we see that it's not adding any kind of a labor or wage or cost to that in the shop management system.
Yeah.
Which if we actually ran the numbers, like one of my clients 3 weeks ago, we were doing the math. And it's that's the thing. I love it. Wayne says it, the math's got a math. So we look at
the math's got a
we're missing $15,000 at the bottom line, but we've got our margins, quote unquote. But when we add back in, we see that, we didn't get a 70% labor GP. We got, a lot less than that, less than 50%, or around 50%. And if you were to add that back in, well, that's where the money went. That's where your net profitability went. We talk about shooting for that 65% GP so that you have that. But here's the thing, and this is the way I like to think about it. So my GP essentially is for every dollar I bring in, like if I were to bring $1 in and my GP was at 50%, that's 50 cents on the dollar. I get to pay my expenses with those 50 cents, right? And so then it comes down to cost controls. And this is where I see a lot of the shops are like, well, I'm getting the margin now. You set your parts margin, your labor margins, you're getting a little better about how you estimate the jobs and the work and all that, and how we sell it. We get more conversion. But at some point, all of that money doesn't make it to the bottom line. Where do
Yeah.
you see a lot of people kind of miss when it comes to expense controls? What are the things that are out of sync or out of leverage or over leveraged?
Yeah. Yeah. Well, a lot of what we see is those who aren't intentional with their spending. So they might be working with a marketing agency because somebody told them to, right? Hey, you need to spend more on marketing. You need to spend 5% of your sales on marketing. They hear something like that. And I'm using marketing because
I'm guilty.
more,
We've said that, but with a
uh-huh.
caveat and an asterisk.
Exactly. Yeah, it is. Go spend 5%. Okay, cool. We're gonna go sponsor my nephew's baseball program. Mm, well, not really
Well,
good
hold on.
ROI out of it. Theoretically, you could spend. Hey, and you know what? And if you spend the same amount on marketing, but it works and increases sales, now we have more. We have a lower overhead cost and a higher net income cost. So that's why I talk about being intentional with your expenses, right? What is my ROI on that individual expense? Will it increase labor, or will it increase gross profit? Will it increase revenue? And if we can increase revenue, we could start outrunning our other expenses after we pay our technicians and pay for our parts. Now we
But a lot of
create
people don't even know
additional net
what
income.
where that first break even is.
Yep, the turnkey rate. And now you have two questions to answer, right? Turnkey
Yeah.
rate on your P&L and turnkey rate from a cash flow standpoint, right? Because we started the conversation about talking about debt service, but on my P&L is our turnkey rate, right? What other expenses do I need to pay? But if I ignore my debt service, I'm not really hitting the cash net profit that I need to, the money that actually will end in the shop, right? Because if we're doing planning on profit, right, ideally we say, okay, we want to hit, and when it comes to profit, I like to talk about dollars and percentage, right? Percentage
Mm-hmm.
says I'm operating efficiently, but dollars are what I can do with that profit.
Exactly.
And if I want to do a build, right, hey, I want to do an expansion on my shop, and I need to earmark how many dollars did I have? And if I set that and I say, hey, I want to hit this profit and have this excess profit to fund this build out for next year. But I forgot that, hey, I also need to include my loan payments in there. I'm going to come up short of that number because the math didn't math.
You didn't do a proper burn rate calculation. I know that I'm going to be spending an additional $5,000 a month for the next 8 months.
Yeah.
Right? They said it's going to be 4 months. I'm going to double up because construction usually takes longer than that.
Yeah.
And instead of 5,000, maybe I'll shoot for 8,000 a month. And if I don't have that 8,000 in my net operating after the fact, well, even then, because you were saying paying the debt service off, right?
Mm-hmm.
All that debt, all that liability that's going to eat away at your cash flow.
You might have the percentage, but you don't have the money then.
You don't have the money and the dollars to pay it.
Yeah, super important to think about that. But now as we're combing through the operating expense section, right away, I'm going to look at occupancy. What's it cost for me to be in my building? Right. Because if I'm at 12.5% for that number, well, I don't have an operating expense problem. I have a revenue problem. That's where my focus needs to be all in on revenue at that point. But if I'm at 4% and my net income's not where it wants to be, but my gross profit is, now we need to start combing through the rest of the expenses.
So first off, you said marketing, and I want to caution people. So if we're already having an issue when it comes to revenue, like overall revenue, one of the worst things we can do is turn off the spigot. So it comes with an asterisk. There's always a few things I look at when it comes to marketing. I'm going to just go through them really briefly. The first is, are we optimizing every vehicle that's coming in? So 300% rule, good, thorough inspection. Are we estimating all the work that was found and identified? Identified and determined. Aldo's going to kill me for that. And old
At least you didn't fumble Kaizen.
You're right. And then the third 100% is that we presented and converted as much of the work as we can. The next thing is, are we actually following up on that deferred work? Because that's another bit of opportunity. Yeah. Then I look at regular touch points with customers. So what is our incoming phone script? That would convert more of our best customers in, and we address that. What does our check-in process look like, where we can set expectations? And also look at things like, making sure, hey, where did you find us? So we know what lead source is going to be most effective. And then at the end, like when we do the customer checkout, we ask for the 3 R's: review, referral, and return appointment. Yeah. Then we look at what is our next best step when it comes to marketing? Our current customers. How many people haven't been in the last 6 to 7 to 8 months that we can call and get scheduled an appointment? Do it on slow day action plan.
Yeah.
Then, not even touching marketing yet, we're going to go to referrals. Can we ask our customers to get us a referral and go through a referral list? And then once we've exhausted a lot of those things, then it can come down to how are we spending our marketing dollars?
I think people forget about how valuable a customer is once they're in your database. Once they exist in your database, what is the cost to get that name inside of your database? You might be surprised. It might be $100 to get that customer in there, just that name in your database. So meaning if I'm rushing through and I'm passing on those opportunities, and I think you listed 5 or 6 easy opportunities.
Oh yeah, and those don't cost you anything other
Correct.
than time and effort and fixing your processes.
But if it costs you $100 to bring this new customer in the door to replace an existing one, right? We're taking that right out of gross profit.
Right.
So if you made $300 of gross profit, you really only now have made $200 because of that initial cost of acquisition.
You had to pay for the marketing. Yeah.
You can say, hey, lifetime value, and justify it that way. But I don't like doing math calculations to justify improper execution.
Oh,
Right.
I love that.
You can find, well, it's like statistics in general, right? You can swing the statistics any way you want to justify what you want to do. But if you do that and you're at the end of the day, you're not hitting your goals, you're just giving yourself an excuse. You're not holding yourself accountable to it.
So I want to go back because right now we talked about, we're looking at expense control. By the way, those of you who joined us later in this live stream, ask questions. We're talking about why you're not as profitable as you think. It looks on paper that you're profitable, but you don't have anything in the bank account. That's what we are conversing about today. Again, joined with Eric Joern from Kaizen CPA. What I want to go back to is you said there's two turnkey rates that we want to pay attention to. What are those specifically? Because we went into them, but I just want to clarify those for everybody out there.
Yeah.
The first turnkey rate is what?
Yeah. What is our net income turnkey rate, right? So how much on our P&L does it cost for us to break even? So we
right. So would that be all expenses plus our debt services?
So I'd do that before debt service, right? Because that's that'll be a cash flow turnkey,
right?
Meaning we're going to take that one step further. So are we operating profit or are we operating at break even, right? Are we charging the right margins, etc.?
So for those who don't, I'd look at things like, what does it cost me to do? So my cost of goods and services plus my expenses, and that could be sales expense, marketing expense, and fixed expenses. Correct?
Yep. What it costs me to be in my building, pay my accountant. I have to.
And so if I were to add that up, that becomes my first benchmark for cash flow, right? My break even for cash flow.
Yep. Let's just say we're in $1 million shop and that number's $400,000, right? It cost me $400,000 to pay my rent, pay myself in the pure owner seat. I'm paying my accountant. I'm paying for my shop management system. I'm paying for my marketing agency, et cetera. All those things.
So at the very least, I have to be doing around $34,000 a month to make that. So that would be my first benchmark to break even. The second turnkey rate is what?
Is now we're talking about total cash flow. So now we have to factor in what my debt service is, right? What do I have to pay on long-term fixed debt? So that's not going to include like a credit card unless you're holding credit card you've accumulated debt on a credit card and you're carrying a balance.
I'd rather assume people are than aren't, because if you look at today's statistics, most people have that debt.
And if you're doing that, my suggestion is you're stopping using the credit card.
Yeah,
right?
Stop it, freeze it, cut it, throw it away. I wouldn't close the account. There's somebody would argue, well, I want to have my credit.
My points.
Liability alone is just either that or set it to automatically pay off every single month, but you still have to account for it. So my second would be, okay, how much do I pay in my debt services monthly?
Yep. So what do I have to pay for debt service monthly? So right, if I have that same example and we're at 34,000 and we have another 6,000 a month in debt service, now we're at
40,000.
Now we're at $40,000 a month.
I would even say add another 10 to 15% cushion on top of that. so that you can have some kind of a plan to pay some of these debts down a little sooner.
Yep.
You know, avalanche or snowball method, whatever that is. If we don't plan for it, then the money's not going to be there for it.
Start building some reserves.
Or build reserves. Yeah. Set aside 10 to 15% just into an account. And for me personally, I like to see 6 months of operating expense. But I had a client, they'll do about 5 million, right? And it's like, okay, well, they're how much do you keep for? I mean, 3 months is going to be. Do you know what I mean? So it's
that better be in a income bearing account, not a checking account.
Money market account of some kind, savings account.
Money market, high yield savings accounts. Those are starting to temper a lot. But I mean, we lived in a world where we're getting 4 or 5% and pretty accessible cash. Huge opportunity missed by a lot all the time. It blows my mind. You open. Great business owner, right? You've accumulated $400,000 of cash and you're earning in a traditional savings account less than 1% of return on that money. It is devaluing as it sits in that savings account.
So if I were to set these benchmarks, I've got 34,000 to hit my cash flow. I've got 40,000 to make sure I'm covering my debt service. Then after that, I can start thinking about what the net profitability is and what I can take home, right? In order to hit whatever that number is. So if I want to make 200,000 in net profit that I get to take home from my investment, I would have to do that after the fact, after that 34 and that 40,000.
Yeah.
Right?
Call
so
that
anything beyond that.
$60,000 a month and
I would say,
in gross profit.
Yeah.
Adding a little cushion, right? I want to factor a little cushion in there. Yeah.
I love adding a little cushion.
It's smart though. It's smart because again, we are people who generally use what's available to us. And
so if it's available, then we're going to use it. Unless we've already set it aside and said, no, we're not going to touch this, then I can't use it for something that I shouldn't be using it for.
Yeah. So if we set our goal at 55 and that's the exact number to hit it, right? We're going to do as much as we need to hit the 55.
Mm-hmm.
But if we set it at 58 and we hit 58, and even though that's got a little bit of slack in it, that means
that month has to make up for the month we didn't hit 55.
Exact. Another great point.
This is something that, just in if we're talking about profitability and revenue and all that, one of the things I've seen is like, look, we're hitting this target for 55%. Let's say it's parts margin. We're gonna hit 55% parts margin. And what they'll do is they'll say, well, some of these things are underneath 55%. I can't charge that much. It's going to be 48. It's going to be 50, whatever that is. Yeah. And then they have one that might be up near 70, and they go, oh, that's way too much. I'm going to dial it down to 60. It's like, no. You needed that buffer to make up the difference so that you hit that average. Again, it's an average, not like the benchmark. We want to hit above it sometimes, and below it we can't help sometimes, but they have to even out to hit that number. It's the same thing with our cash flow. You're going to have months where you're going to do 60,000, 65,000 revenue, but then you'll have months that are going to be a lot closer towards where you don't want to be, where you're starting to outkick your coverage. You're starting to dip into your cash reserves, right?
What happens in January, February, right? When our revenues naturally dip out of seasonality. All of a sudden, maintaining the same rate then as you do in June or July when things pick up, that generally doesn't work that well.
I think oftentimes people forget most of this is two things. Like right now, we're kind of talking about a little bit about generating revenue, but most of this conversation is going to be about expense controls. And the thing is, you can only go down to zero as much as you can. Right? Yeah. You're gonna hit that 0 point and go, well, I can't go any lower because this is what it costs to rent my building. This is what it costs to, pay these softwares and licenses or pay the employees and all that. And so then the question is, what are we doing to increase revenue? Right? Yeah. But let's talk more about our expense control. So one of them we talked about was marketing. The second we talked about was occupancy, or your rent or your lease or your mortgage, whatever that is for the building you're in. What are other areas that we might want to look at? Insurance. And how do we know that we're out of whack with that?
Yeah. And it is where things get more difficult, right? While it's a lot easier to spend time concentrating on gross profit, right? There's millions of benchmarks on what we need to pay for a technician, what we need to get for markup on a part, and how to handle that. And it's impactful, right? But once we get past that, it starts getting more complex, right? Because insurance, how do you know how much you should pay in insurance? And now you have variabilities around, do we provide health insurance for our employees? Where are we located? Have location has a significant impact, right? If I have a shop in Florida, my insurance load is going to be astronomical compared to South Dakota.
Yeah. And it's
And
important to have some grain of grain of salt there. That's why we look at in our gear performance groups, we're looking at comparative data there.
peer
Because
groups are a great way to do it.
Where's that benchmark, and how do I compare against that? But that doesn't necessarily mean that that's the end all be all. You might have a benchmark that's going to be a little higher. Like for instance, I had a client, and they're kind of in a family situation where they sold the business. They're doing it where they're paying out an employee kind of a rate on that, and they're still kind of working in the business. So it's like, okay, well, if we looked at all this, their margins are all where they need to be. Okay. But they're hitting at, 5 to 7% net profit. And it's because their employment expense is way too high, because they have too many bodies for what that business is supposed to do.
Yeah.
Right. And so it's like, okay, well, if this is the situation, they're a C corp, how they're formulated and everything. So it's like, okay, if that's the situation, then our benchmark for net profit can't be 20%. It's got to be 30%.
Yep.
And then we work back the numbers from there. And that'll end up making sure that you drop the 20% that you're looking forward to at the end of the year. Like we use these benchmarks to make strategic decisions about how we control our expenses and how we manage these things. So other than occupancy, what are we looking at?
Yeah. So we're looking at, we've looked at occupancy. We've talked about marketing. We've talked about insurance, and insurance. You can just go, right. You can go shop rates. Even us as a firm, right, we participate in a peer group similar to gear performance groups. And one of the things that we found was our IT spend was dramatically higher than the rest in our group. And we went out and we did some market evaluation. And we found that, hey, you know what, we agree. And we went and found a way to cut that expense pretty dramatically. So as you go through your P&L, right, great exercise. It might not be hey, here's a specific dollar I need to hit, but this might say, I'm spending much more on this expense than anybody else that's in my peer group. I should probably go shop and talk to other providers that can provide this service. And it could be something as small as, I've been using Cintas for uniforms and cleaning carpets and all that fun stuff. And, maybe I have some extra people that are in my shop that have nothing going on, or not as much utilization. Maybe we buy a washer and dryer and clean our own uniforms. And I think that's probably a crazy idea. But it's using that thought and creative exercise to come up with concepts like that.
I like looking for the gap. So like if I've got a goal set, okay, and we can use that same example you're talking about, 34, 40,000. Let's say our goal is 60,000. We have that gap of 20,000 we got to make.
Yep.
Right. And so what I often fear is that people go, okay, well, I'm looking for the one thing that's going to get the $20,000. It's like, no. It's a combination of things. So what can I reduce in my IT expense? By the way, we did this last year and we cut it down to a seventh of what it was annually.
Wow.
And that was one of those things where it's like, okay, well, we saved that much money. Okay. Now we can look at what do we do to increase our revenue. It might be looking at your average repair order, increasing your inspection process, or building a better sales presentation, or adding more value, or even your marketing can curate the types of people that you're bringing in who are going to value your business more than those you're currently bringing in. So it's all of those different strategies combined to make the difference of that $20,000 gap.
Absolutely.
It can't just be, I'm looking for the one thing. It's, I'm going to have things that are going to add to it. I'm going to have things that I can take away to make that gap happen. Right.
Yeah, it's
and if we
death
do
by
that,
1,000 cuts, right, is the principle of it. Think about your personal spending, right? Amazon has probably created a lot more debt in the world, in the consumer world, as possible, because it's easy. They made it so easy to buy. And, hey, it's $10, it's $15, it's $10, it's $15.
Yeah.
And then you look at the month and you spent $800 on Amazon, and you're like, what did I buy? And how often are we doing that inside of our shops too, right? Hey,
my wife was a little upset with me recently because we ended up deleting DoorDash.
Mm-hmm.
Okay,
that's a big one. Yeah.
But it's like those little things, they Raindrops
Yeah.
make oceans, man. So
Yeah.
we covered marketing, occupancy, insurance, IT spend. Let's do one more. What's one other big area that people tend to miss in their expense controls that are not allowing them to get the net profit that they're looking for?
Yeah. I mean, labor is always a sensitive category, right? And we oftentimes, when we're talking about shops and we focus on gross profit, we're talking about technician labor. But then there's all sorts of other labor that falls below the line, meaning we might be paying our service advisors. So, right, are we paying our service advisors correctly? And are they right for the amount of volume that our shop has? But maybe we have multiple, maybe we were paying an office manager, we're paying a third party bookkeeper, and we're paying a CPA.
Maybe we're a little top heavy when it comes to our,
Financial back end.
exactly, our management suite or whatever that looks like, right?
Yeah, or maybe we have duplicate subscription. The subscriptions really is where we find it's never big dollars, right? It's the $100, $200 a month. But I can't tell you how many shops we've gone through the GL with them. They say, "I thought I canceled that," or "Oh, we haven't used that in quite a while." And maybe it was a one-time use. It was a labor guide I needed specific access to figure out how to execute a certain repair, and it's on an auto renew. And I've continued on that subscription.
Well, like we even made a switch recently, mid last year, but we went from Slack to moving to just using Google Chat. We had the company. We're like, oh, I don't know why we didn't do this before, but I mean, when Slack is $500 a month, $600 a month, $700 a month, depending on how many users you have, that adds up. So, what are your software subscriptions that you guys are paying for that you're not actually using?
And it doesn't have to be you have to cut the whole software, but sometimes you need to cut user seats. We did the same. We did a similar thing with Adobe, where we had Adobe. It ballooned because we thought everybody needed it, and then we looked at this. Next thing you know, we spent $20,000 in Adobe licenses, and we said, "Oh, something's wrong here." So we went and interviewed the staff, and turned out about 10% of the staff used it more than weekly. And we said, there's got to be a better, cheaper alternative. And maybe these power users need seats, right? Or, we operate on a ChatGPT team subscription. And while we could just go and say, everybody needs ChatGPT now. That's great. That cost our firm, I think it's like around another $20,000 a year if every single employee got that subscription. But instead, we are asking our team to request it. The why, how often are you going to use it? Are you using a free version with non-sensitive data first? And you're using that on a regular recurring basis because we want ROI out of that product again, right? Okay. You're using it regularly. Now, how can I measure the noticeable improvement in efficiency? And now I can calculate an ROI. Does it make sense for me to spend the money on that? Because
something that just a simple calculation of what's my ROI on this it could save a lot of dollars. We have go ahead, Eric.
One interesting. And we got a good question here.
We had a question. Sorry. What's the question? It's Todd Ainsworth. So, what do you think is a good target percentage for social media presence?
Wow, I wish that was an easy question to answer.
That's a really nuanced question because you're talking about marketing in general. Marketing could be anywhere from 5 to 10 to 12%, depending on if you're maintaining or growing, at least what we've seen. But for me, it depends on your return. So if you're getting a 5-to-1 return on your dollar spend for social media, then keep going. But if you're getting a 1-to-1, that's something to consider. Maybe another marketing campaign or another marketing area. Like your Google ads is getting a much higher dollar to dollar ratio. So take the expense from that and put it towards there.
Yeah, I avoid generalized P&L percentages when it comes to marketing spend. I think you have to dig deeper, right? Yeah. So what is my cost per acquisition, my lifetime value for that customer? And so you need to know your gross profit, my lifetime value. So here's how much revenue I have through the lifetime of that customer. So say my average customer visits me 20 times in their lifetime, whatever it may be. And they spend X amount. This is my ARO. And here's my X amount gross profit percentage. And here's what I had to pay to acquire that customer, whether it's a social media presence, whether it's a mailer, whether it's whatever it may be, right? And that will answer your question individually on that decision.
I was doing the math. So if they brought, if our clients came in 20 times in their lifetime, it's $750 average pay order. It's around $15,000. And let's say my cost per acquisition is 50. I don't know. I've seen a wide range. So depending on where people are at, they might have population density. They might have to invest more. But anywhere from 50 to 150 for your cost per acquisition, right?
That's a pretty good ROI.
That's a healthy ROI. But if it's 500, or like I had somebody who was doing radio ads and they only got 3 people in, but it was $1,600 a month for radio ads. That's not a good ROI.
Your lifetime value is, $2,200, right? And then your gross profit is 50%. And then it costs you $500 to acquire a new customer. So really, the lifetime value you get out of that customer is like, I think that was $612 or something around that. That's not going to pay bills long term for your shop. You're not going to be able to have that growth. And actually, when it comes to percentage, I think something that's really important to pair with your marketing cost is how much costs to be in my building, right? Because if I'm on an interstate or I'm in a high dense populated area where people are Googling looking for an automotive repair shop, it's going to be a lot cheaper to bring them in the door than if I am off the beaten path in a more rural area. The cost for me to get somebody in the door might be significantly higher.
Well, and frankly, marketing is something I really love because I want to challenge those out there. If you've got a marketing budget, be really creative with it. Embrace those restrictions, right? So somebody I was working with a little while ago, they had like a, $50 off if you spend, X number of dollars with us as a promotion. Okay. Well, I could be really creative with, $25 and have fresh baked cookies that I could be giving to my new customers that come in, or, be more creative with that and donate it to a local, community center that is, really embedded in the community and does good things. And it's like, you could be so much more impactful with your dollars than you think. And it doesn't necessarily have to be like a transactional thing. It could be very cultural. It could be, a lot of the value elements there, and reinforce the type of people that you were trying to bring in.
You can host an event to show somebody how to do a pre-road trip inspection of their vehicle. Something like that, right? Gets them in the door, makes them think about how important the safety and reliability of that vehicle is long-term. So, and who's going to show up to that event? Probably your ICP, your ideal fit customer. And that's another whole marketing concept you can go down a rabbit hole of, is who is my ideal fit customer? Because I see these questions on the Facebook groups, on the forums, they won't like that labor rate, or they won't like that part markup. And my question,
put a lot of our own biases on that. I feel
our own bias. Sometimes. And then is your ideal fit customer the person that understands what a labor rate would be to go somewhere else for a shop? Or are they looking at, hey, how much will it cost to get my car operating safely back on the road? And what am I willing to pay for it? That's generally your ideal fit customer. And do they value good service, fixing it right the first time, and probably time, right?
So one of the things I want to touch on right now, Todd, by the way, thank you so much for the question. Those of you out there who have any more questions, me and Eric are watching the chat. We want to answer them live while we have you here. One thing I want to touch on is we can talk about these expense controls all we want, but a lot of shops out there I know are likely struggling with one of the biggest hurdles is visibility. So you're telling me, why am I not profitable? I could see the numbers in the shop management system, but my P&L is not great.
Yeah.
Here's where I'm going to recommend, we've been working with Eric, and frankly, you guys and your team have done the majority of the work, but put together a kind of a chart of accounts program build. So if you guys are really struggling to just get it organized and get it clean so you can see what's going on, Eric now has a service that we're offering through the Institute. Do you want to talk a little bit about that?
Yeah, 100%. And I'll open up with something we found. We just finished going through this exercise with somebody, and one of the things we found was through their prior accounting process, they had bought some equipment on lease. Well, I guess I contradicted myself. They bought equipment on lease. So when people see lease, they think I have a monthly expense that I'm incurring for that. but there's a difference between what's called operating lease and a capital lease. So he had a dollar buyout at the end of the lease, which that means we're effectively, we bought that equipment on a loan. They just called it a lease. So that's called a capital lease. Well, guess what? In the prior year, if we would have treated it correctly as a capital lease, we could have accelerated all the depreciation, taking it in 1 year versus spreading that out over the lifetime of the payments. There's cost benefits. That's a whole nother decision matrix. But our goal is something as simple as that is, hey, we need to educate you around that's how you handle this. So you have the opportunity to make that decision, right? If you don't do it right, you no longer have the opportunity to make the decision on how I take that as a deduction. And is it an accurate reflection? If I own that at the end of the day, I don't think I want that in my lease expense account, right? I really want to know, hey, I now have an asset that my business owns, and I'm going to look at that much differently than I look at something that I have an ongoing expense for. And a bank looks at that differently too.
So frankly, a lot of you out there might be struggling with, well, I don't know what decision to make because we just don't have the visibility. I would urge you. I mean, it's worth the time and the effort to get this done. The money to spend is totally worth it. The return on investment. Think about being able to make all the strategic decisions that we've been talking about with good numbers so that you can do the math and actually see what the ROI for, the expense controls would gain you in an annual year or even for the lifetime of your business over the years. It will save you so much money and earn you even more. And I highly advise, reach out to Eric and Kaizen and get that service done for you if you don't have clean books.
Yeah. And I'll walk you through the process really quick of what that looks and feels like. Because even if you don't go this route, think this through, right? So we start off and we do a call. We have a questionnaire, and then we have a call where we talk through the questionnaire. And that questionnaire identifies items in your accounting process that we might feel becomes gaps. So then we're going to address maybe even some operational things that you're doing inside of the shop that aren't even just on the P&L itself. And then we're going to make sure that Institute GPG ready reporting chart of accounts is loaded into your QuickBooks file. We're going to make sure we build a system that matches your shop management system back to your books. And obviously, we're also going to coach you around your shop management system and making sure you handle transactions correctly in there so you have accurate reporting. And then we're going to create you a roadmap on exactly how to replicate that every month. And you walk away with essentially a built accounting system that you can hand off to your bookkeeper, or you can, if you're executing it yourself, you can execute it yourself. Or, I have a feeling in many cases we're going to, provide enough lift for our client or that person that we're working with that they say, hey, I don't want to deal with this. This is much more complex than I thought, and you guys just keep doing it.
I highly recommend getting it done. Whenever we start with a new client, that's, we address things like the urgent needs in care. And then the immediate next step is how do we gain visibility? Because we can't make good decisions that have lasting, impactful, positive results if we don't know what's going on. And that visibility is massively important. All right. We're kind of in the final minutes here with this AMA. Anyone out there watching now, if you have any questions about, why you're not as profitable as you think you should be, this is the time to ask them. I was thinking about this. I was in a manager performance group meeting a little while back, and they were doing an exercise on proficiency. Now, proficiency is really just how are we optimizing and utilizing the available hours that we have. And this is in conflict with efficiency because they're like, my technicians are productive. It's like, no, your technicians are efficient. So when they're on the vehicles, they are getting the work done in a very timely and efficient manner. However, you're not utilizing all of the available time that you have in the shop. And that comes down to the shop's workflow, right? Mm-hmm. And we were doing some math, and between, the groups here, we found $5 million of unutilized potential.
Wow.
And it's like, look, and everyone kind of was like hanging their heads. It's like, oh my gosh, we missed fight. It's like, no, look at this. This is a good thing. Look at all this opportunity we just found. We just found $5 million. Okay. Then it comes down to just improving your workflow. How do we schedule out? Are we maximizing the technician utilization, their time? Are we setting their day up for success? Are we communicating effectively? Are we managing our parts ordering effectively? Or, all those things that come operationally that if you've got the numbers dialed in, and this is where I'm like, this is a frustration of mine. You're working with somebody, they're like, I need more cars. I need more this. And it's like, if you have a system that is fundamentally broken and you want to dial that engine up to, 200-300% of what it's doing, all you're doing is exacerbating those core fundamental issues that are there in pre-existing. And so I want to optimize before I increase. Personally, that's my statement.
The worst thing you could do is have to hire another technician because you've increased car count because we're not efficient or we're not optimizing. We're efficient on the car,
And
but we might not be efficient in our process.
You're stretching the work for 3 technicians across 5 technicians, and then you've got those additional 2 annual salaries weighing down your expense controls. And so again, where's my profitability going? Well, I'm paying probably far too much for labor because we just didn't optimize the system. Not that any of those 5 technicians are doing the wrong things, but if you're going to have 5 technicians, let's make sure they can produce the work of 5 technicians.
And then the knee-jerk reaction is, I got a bad technician, right? Is the first thing that they think of is, oh, they're at 50% productivity. They're a bad technician. No, always start with you and your process and your system. And are there cases I made the wrong hire or the wrong person's in the wrong seat? Sure, that can exist. But
I'm just going to assume that people are doing their best first.
Yeah, exactly. Until you rule out that my systems, processes, and procedures are not failing them, you can't put it on the employee.
Yeah. So we covered marketing, occupancy, insurance, IT spend. I love the IT and software. That one is such a time sink. Labor, right? And then subscriptions. Anything else?
Now I have to think through a whole P&L. I mean, we never talked.
You don't have them layered out in your head, man.
we never really talked about parts, and we talk about parts gross profit, which is largely managed through the shop management system. Parts leakage to me is probably one of the largest expenses that we see that are outside of, I guess, the initial gross profit measurement.
So let's talk about parts leakage for a second.
Yep.
What is parts leakage?
What is parts leakage? So normally people think about it as, hey, people are stealing from me. Usually not the case, but sometimes the case. But maybe we're not charging for parts, right? Or, hey, this is too much work for me to tag this on an RO. And, let's talk about a drain plug gasket, right? Let's say we do 300 oil changes and drain plug gasket cost us 25 cents and we 4X it on our pricing matrix. That's $1 per car. Times 400 cars, it's $400 a month. It's $5,000 a year right there. And that's just, and trust me, I hear it's not worth me doing that. And I think
$5,000.
That's $5,000. And then you get into $5,000. I mean, that's a pretty decent vacation. You have those personal goals. Hey, $5,000. If you, let's just say your cost of customer acquisition is 20%, right? That is now $100,000 in new revenue if my maths.
Yeah, if we're not ordering the correct part or maybe a cheaper part, we're going to end up paying warranty on that, or we're going to eat the cost there. Are we not managing our cores properly, right?
Or return process. Are we not doing a statement reconciliation? Are we not comparing our parts usage report back to all the parts that are tagged on a repair order? I mean,
that can save you so much money in the long run because you've got all this inventory that essentially isn't being leveraged the way that it should be. Same with the labor inventory. We're not utilizing it as best as we can.
Yeah, it's leaking, right? Generally we're not mispricing. We're just letting stuff drift, right? We haven't sharpened our processes, systems, and procedures to account for all these things. I mean, we're working with a 3-location shop group, and we did I don't want to call it an audit because we didn't do an official audit, but we did an analysis of their parts spend versus their parts usage inside of their shop management system. And we found $100,000 gap across 3 stores in a 12-month period. And then we've narrowed it down to, hey, what my parts purchases logged in my shop management system accounts for 50% of that. And then the other percent just is not accounted for at all.
This is what drives me a little nuts is like, it's not like a lot of the stuff that we're talking about, it's money that's already there. This is stuff that's already in the shop. It's not doing any excess. It's just being a little more judicious with what we're doing, right? I'd love to take a moment here, just those of you who've been watching the live, just to talk about some of these categories. I'd love to know in the comments where you feel or where you think you could probably do a bit of expense control. And so those categories are marketing, occupancy, insurance. I'm gonna put IT spend and subscriptions together.
That makes sense.
Labor, and I don't mean tech wages. I mean, payroll,
Overhead, labor.
and the last would be parts leakage. Where do you guys feel that you could save some dollars there? Let me know in the comments.
Oh, yeah.
Sorry, go ahead.
I might, while people are punching that in the comments, another overhead expense, and again, doesn't move the needle, but everybody can do it. And it's a very easy thing to go shop. Your credit card processing fees.
Oh my gosh, yes.
And, I know there's a whole dynamic now around, should I pass that on to my customer at this point or not? What's your take on that?
Here's the thick of it. If I want to make the 20% for fair profit, my consumer is going to pay for all of that, regardless. Either it's going to be loaded here or loaded there. It's going to be in my labor, in my parts. It's going to be somewhere. I think if you're talking about eating the credit card processing fees, just make sure you're compensating it somewhere else. And frankly, I'd rather have a consistent experience for all of my customers. So I just eat that, but make sure it's calculated somewhere else. It's a better customer experience, right? Mm-hmm. If it's negligible where it is, then look at the customer experience.
Yeah.
Okay. And then the last bit of that is, think about the savings. If you're processing $1 million in a year and you can save 0.5% on credit card fees, how much is that?
There's your $5,000 vacation again.
Yeah, it's a lot of money. It adds up. So we're just at the end here. I did want to say, the Institute's doing a launch live stream on Monday. That's going to be 1 p.m. Mountain Time, 2 p.m. Central. We'd love for you guys to tune in. We're giving away some fun prizes, and we're doing the launch of the Out Academy, going into some details there, some training. And we'd love for all of you to be a part of that. Eric, this has been fantastic. Those of you out there who are curious about our financial intensive, we'll post, in the follow-up here, some information there, as well as the chart of accounts services, or I don't know what we're exactly calling that, but getting your books cleaned up. You guys do a fantastic job, so check out Kaizen CPAs for that. Any final comments on this?
Hey, everybody should walk away from this meeting right now. Go look at your general ledger. Start looking at those expenses that you're paying for. What don't I need, right? Am I in too big of a QuickBooks subscription? Did I pay for HR services in my payroll processor that I'm not using? All these things, if you spend some time going through it, I bet you'll find probably that $5,000 vacation today.
Awesome. Eric, thank you so much for joining me. Those of you out there, are we hanging out for a little bit? No. Follow up. We'll post the recording of this later. Thank you all for being here, and we'll see you on the next one.
Thanks, everyone.